In this video, we'll discuss getting your financing in place for investment properties and additional costs that come with it. So first of all, how do we begin getting into financing? Well, first, if you're looking at getting a loan of some sort to go ahead and finance your project, then these are the things that we really want you to pay attention to as you start getting prepared as a career in real estate investing. Number one, check your credit score. Typically, loan companies, banks, hard money lenders, they all prefer at least a 640 score or better. So if you haven't done it already, what I do is every year around my birthday, I go ahead and I get on freecreditreport.com and I pull up my credit score and check all three of my bureaus. So that'll be Experian, it'll be TransUnion, and the third one, excuse me, because I don't use that one too much. But you want to check all three of your bureaus there. Typically, of course, if you live in the um, East Coast, if you're somewhere on this side of the Mississippi, most likely Experian will carry the most weight because this is the southeastern depository of most people in the United States of their credit score. And then, of course, if you're over on the West Coast, then TransUnion will probably be the next big one there. And then, of course, the third one will cover the middle of the states. But really, you're looking for a 640 score or better. So then from there, what you want to do is if you have a 640 and better and you're ready to start financing, you want to shop around for rates. Just because you're looking for your first deal doesn't mean you have to be desperate. You want to shop around for a good APR whenever you're doing a loan. Typically, if you go to a bank or credit union or some sort, then the rate's going to vary depending on the national APR. And so currently, if you get anywhere from 3% to 5%, then that's typically decent right there for a investment property. Now, if you're looking for your primary residence, obviously, depending on your credit, you could get much lower than that. It could be in the 1s and 2% as far as your APR is considered for your conventional loan. If you're doing a hard money lender, okay, a hard money lender allows you to borrow money for a short period of time, typically because you are looking to either flip the property or do a quick renovation and sell it back in the market. Typically, these loans are good for 60 days, 90 days, no more than about 6 months of repayment. So typically, you'll get the money quicker, but you'll have a higher APR. And typically that may range anywhere from 5% to 7% as far as hard money lenders are concerned. The biggest thing is if you can, get pre-approved for your deal. Go ahead and start working out numbers with that particular lender and see what you can lend on. Now, of course, depending on the type of project or deal that you're looking at, if you're looking at a single family home, of course, you'll be pre-approved by your bank so that you can go ahead and purchase your residence. But if you're looking for an investment property, if you're looking for quadplexes or you're looking for multifamily, typically if there's 5 units or more, they won't concentrate as much as your income, but more so they're going to look at your credit rating compared with the income that could possibly be generated from your investment property. And that's why I typically like to start investors looking at 5 units or more. So there's not a big emphasis on your personal income, but more so they look at your credit score and then they'll look at the income that the property can generate to pay back the loan. Now, let's say you have a few blemishes on your credit. What do we do proactively so we can get your credit in line so that you can begin investing in real estate property? Well, first of all, what creditors look for, this is what we want to define so you'll understand what they're seeing. Number one, they typically don't want any bankruptcies within the last 2 years. So that means the date of your bankruptcy, you need to have at least 2 years cleared before you can go ahead and get some sort of financing in place. If you do have some blemishes other than bankruptcies, and what you want to do is you want to try to clear up those collections that are on your credit. And typically what I always recommend is that you settle out those collections. And basically you can offer 50 cents on the dollar, 40 cents on the dollar, 60% on the dollar. So as an example, let's say I have $1,000 bill from a credit card that I hadn't paid, possibly because maybe I lost a job, divorce, or whatever the case may be. I would contact that particular lender, the originator of the lender, and I'll say, hey, look, this is how much money I have. I'll agree to pay you $400 if you'll go ahead and settle out this collection and have a zero balance. It does two things. Number one, it immediately go ahead and closes that debt so that your utilization rate will go up. Number two, it'll help improve your credit score. And number three, it helps save money in your pocket instead of paying the full balance. Typically, collection agencies and borrowers, they just want a portion of their money back because they know if a certain time has passed that the likelihood of getting the full balance is very rare to none. And you calling and making arrangements to pay a portion of that will definitely help you in the long run to get your credit back in line. Just some words of advice. You want to go ahead and try to offer a settlement near the end of the cyclic month. So that means if it's 30 days, somewhere around the 25th to the 27th, you want to go ahead and try to offer a settlement because most collection agencies are more apt to accept a deal at the closing of their books. Second thing is, if you agree on a settlement price, ask them to submit to you in writing before you pay them the funds. So in that example I used earlier, if it's $1,000 balance and I offered $400 to settle it and they agree, then what I request is that they email me or fax me a settlement in full letter that shows that they will accept $400 to clear the debt. Once I receive that letter, I will immediately send the funds either by PayPal or Western Union or credit card or money order, whatever works best. And I will agree to send those funds on the date that's signified on the letter. You want to have a record of that because in case they do not honor their side of the bargain and report it as clear, you can take that letter of the settlement in full letter and submit it to the credit bureaus, and they will immediately go ahead and change your balance to a zero settled in full. Now, another thing to look at is, let's say you filed a bankruptcy, but you have no credit. What you want to do since that 2-year bankruptcy is you want to establish some lines of credit to establish good history. The biggest thing is you want to have a track history since you had a bankruptcy, which will be more friendly for banks and lending institutions to accept you as a customer. So opening up either a secured card or unsecured credit card will definitely help, or maybe a very small loan. And then what you'll want to do is, at least for the next 3 to 6 months, you want to pay the monthly payment on that on time to create a history record for your score. That will immediately help your score go up. A lot of people have discussed that they'll go ahead and charge maybe $200-300 and then immediately pay it off the next month. That does not help to raise your score. The reason being is that your score is built upon credit history. If you just pay something off in 30 days, you only have 30 days of history, which is not enough to go ahead and raise your score. Instead, if you pay your minimum payments or some nominal payment and you stretch it out for at least the next 6 to 9 months, that will be sufficient history and it will considerably raise your score by a couple hundred points. Number 4, keep your utilization percent under 30%. Now, what is utilization rate? Credit card companies or debt collectors or finance companies, they look at how much you're paying out in debt compared to your income. And if you're paying too much out for your debt, then your utilization rate will be high. And so you won't get a good rate on your loan if you get approved. A lot of times, if your utilization rate is over 50%, you may not be approved for a loan. So it's very crucial that you keep your utilization rate for your debt very, very low. Typically under 30% is good. If you could keep it under 10%, that would be great. And then, of course, the big picture is, as you become more mature in real estate investing, eventually you may want to go ahead and start having some sort of business entity to house your investment properties under. Reason being is you want to eventually separate your personal credit away from your investment properties. And you want to do this so that you can protect yourself financially from any accidents or lawsuits that may happen on one of your properties. So as soon as you get your first couple properties and you have some good income, go ahead and start putting income aside and start establishing a business entity and then placing those properties under that particular business entity umbrella so that you can separate yourself financially from that in case of a potential lawsuit. Now, let's talk about the down payment that's necessary to get involved in investment properties. Typically, you'll need 20 to 30% of the purchase price as a down payment. And here we discuss three different ways that you can obtain your down payment. The first way would be you just save for it. A lot of people are working, they're saving their money, and yes, you can go ahead and save your way to getting a down payment. The second way we can talk about is you can borrow the money or partner with somebody. Perhaps you have good credit, but you don't have down payment money. So in that case, you would be in a joint venture or partnership with somebody who does have money, and then you could go ahead and partner with them to get the property. Only thing is you will have to share profits and you get to share expenses. But it also could be a rocky relationship or it could be a great relationship. If neither one of those options work for you, then the number one option that I always recommend is Forex trading. That's why you're a part of DKS, because we're here to put the pieces of the puzzle together to move from growing your money to becoming an investor of your money and continuously growing it through other vehicles like real estate. There's nothing like trading Forex because here you can take a nominal amount of money, anywhere from 50, 100, 500, $1,000, and grow it so that you can use this for your expenses for your real estate property. And typically, I will always go ahead and default to learning Forex so that you don't have to spend additional money. Also, you don't have to partner or borrow the money and incur another loan or another debt or be indebted to anyone. Instead, you can grow your money and then place this as your down payment for your investment property. Let's talk about the additional costs also that's associated with your investment properties that you can't ignore. Here are just 11 different extra expenses that you'll look at. Some of these will be included into your financing, and then some of it you will have to pay out of pocket. Number one, your inspections. Inspection of your investment property is typically paid out of your pocket. That can range anywhere from $300 to $1,500, depending on the size and type of the property. Number two, appraisals. Appraisals are typically done by the financing institution, but that cost will be bundled up into your financing, so you will incur that cost as part of your purchase price. If you decide that you want to keep your purchase price low, you may want to go ahead and pay appraisal out of pocket. Closing costs. You can either come to the table, the closing table, with your closing costs and pay that out of pocket to keep your financing low, or you could bundle that into the financing, and then of course that will up your principal on your loan to which you'll pay. Title insurance. Title insurance is normally rolled into your mortgage, and so you can pay that, or you can pay that outright. Property insurance, same thing. You can roll that into your mortgage, or you can pay that outright. One thing on your bottom line you'll have to take into account, if you're buying and holding a property, which means that you purchased it as an investment property and now you may have a renter in it, or you're holding it for a few months until you're able to sell it, there may be some maintenance costs involved. So it's good to have some money set aside for maintenance costs. The next will be taxes. Taxes can be opted to either pay inside of your mortgage, or you may have to pay that yearly outright. Renovation costs. Renovation costs, depending on the type of deal that you're doing, are typically going to be paid out of pocket by you, the investor, to get done. But there are different options like hard money loans, which will allow you to get a percentage of the appraised value and have those funds able to do renovation. The loan will be paid off once the property is sold, and then you can recoup those funds. Lawn care, that is an out-of-pocket expense that you'll have to pay just to maintain the lawn, if there's lawn on that particular property, until the property is sold. Utilities, of course, if you do any open house and you're trying to show people the property so you could go ahead and get it quickly sold, you probably have to pay utilities. And then vacancy rent. This is more for our multifamily units and commercial properties. Most likely, if you're renting out the property, there'll be a number of units that may not be inhabited or have any renter in them. So you'll incur losing money. And of course, that affects you with your vacancy rent. So that is a cost to you because you are not making income. You are losing potential income by not having that particular unit rented out. That concludes this video. Thank you for watching and stay tuned for our next class.